Think of a residential mortgage-backed security, RMBS for short, as a giant money box filled with thousands of home loans. When people buy homes, most can't pay the full price up front, so they get a mortgage from the bank. That's a loan they pay back monthly with interest. Banks give people mortgages so they can buy houses. Now imagine the bank has thousands of these mortgages. That's a huge amount of money tied up for years. Instead of waiting decades to get that money back, the bank wants it now, so it can make more loans or invest elsewhere. To do this, the bank bundles lots of individual mortgages, say £1 billion worth, into one big pool. It then issues around £1 billion worth of bonds, which are backed by this pool of mortgages. When homeowners make their monthly mortgage payments, the money flows into the pool, and from there it's passed on to the investors who bought the bonds. Investors buy these bonds because they earn interest, just like the bank earns interest from homeowners. Here's the twist. The interest rate homeowners pay on their mortgages is usually higher than the interest rate. The bank promises to pay the RMBS investors. That difference, the extra interest, is profit for the bank. Example: homeowners' mortgage rate, 4%. RMBS investors' rate, 3%. The 1% difference is the bank's profit, but it's also a cushion to protect investors if things go wrong. Not all RMBS notes are the same. They come in layers or tranches from safest to riskiest. At the top, AAA notes, safest but lower return. At the bottom, B notes, riskier but higher return. The idea is simple. Safer bonds mean lower returns. Riskier bonds mean higher returns. If you want safety, go for AAA. If you want bigger returns and are okay with more risk, go for BB. Every month, homeowners make their mortgage payments. That money flows into the mortgage pool and then is handed out like a waterfall. AAA note holders get paid first, then AA note holders, then A, BBB, and BB note holders. If there's still extra interest left over after paying everyone, the bank keeps it as profit. This waterfall means the safest notes get paid before the riskier ones. Sometimes people lose their jobs or run into trouble and can't pay their mortgage. What happens then? RMBS are built with layers of protection before investors lose money. First line of defense: homeowners' equity, deposit. Banks don't lend 100% of a home's value. Example: a house costs £100,000. The homeowner pays a £30,000 deposit and borrows £70,000 from the bank. If the homeowner defaults, the house is sold. Their deposit, or equity, is lost first, before the bank or investors lose anything. Even if the house is worth less when sold, the loss comes out of the homeowner's deposit before the mortgage pool feels any pain. Second line of defense: the bank's profit, excess interest. The interest rate on mortgages is often higher than the rate paid to RMBS investors. That extra interest, called excess interest, acts like an emergency fund. Before the bank takes any profit, this money can be used to cover missed payments or losses. In most cases, excess interest is enough to cover almost all losses from the mortgage pool. Third line of defense: reserve fund. At the start of an RMBS deal, the sponsor sets aside money in a rainy day fund to protect investors. If excess interest isn't enough to cover losses, the reserve fund is used next. When borrowers make their payments in later months, any extra interest first goes to refill the reserve fund until it's back to full. The bank only keeps what's left. Remember, both the excess interest and the reserve fund come from the bank's profit and capital. Before investors lose a cent, the bank loses its excess interest profit and reserve fund. Only if all of those protections are used up do investors start taking losses. And even then, the risk is passed to the most junior bonds first. BB, then BBB, then A. While the senior bonds, AAA, AA, are protected for as long as possible. In Europe, lending standards are strict, and most people pay their mortgages even in tough times. Combine that with the deposit requirement, the excess interest, the reserve fund, and the waterfall payment structure, and historically, RMBS investors in Europe have rarely lost money. So, in the simplest terms, banks give mortgages to homeowners. They bundle those mortgages into RMBS bonds and sell them to investors. Homeowners' monthly payments flow to investors, starting with the safest AAA bonds. Any extra interest goes to the bank, but it's used to protect investors first if trouble arises. The reserve fund, money the bank set aside at the start, is used next if needed. The bank loses both these buffers before investors lose a penny. The safest bonds get paid first, while the riskiest bonds take losses first. Follow for law and business, minus the jargon.